So this topic is money market. So what is money market? Basically, money market is a very important component in our financial structure. If you recall from your previous unit, that is the interest rates, we said that the interest rates are determined by the demand and supply of money. So money is the main thing of every business. The money market is exactly where the short-term borrowing and lending of funds takes place. So before we go to deeper sense, just let me ask, when a bank needs money for just a one day, where does it go? It doesn't go to the households. No one bank comes to me ki please lend me some money for one day. So basically bank goes to the money market. So from there the concept will arise, the concept of money market. What are the definition? The money market is a segment of financial market where the short-term borrowing and lending of the funds takes place. Usually for the maturities of up to 1 year. What are the purpose of this market? Mainly to provide the liquidity to the banks, governments and the business, to enable the short-term investment opportunities for the savers and to balance the temporary cash surplus and the deficit. What are the features of money market? So basically the money market deals in short-term funds within the maturity within 1 year. Highly liquid instrument, helps in monetary policy transmission, and basically the participants of the money market includes the Reserve Bank of India, all the commercial banks, all financial institutions, mutual funds, corporates. As an example of the instruments of money market, we all know treasury bills, commercial papers, certificate of deposits, call money, repos. If a company like suppose Tata Motors has a idle cash for 3 months, it may invest in treasury bill. On the other hand, if SBI is suppose short of funds today, so it borrows in the call money market overnight. So by this market, basically Tata invests their money as idle money to the money market, and SBI needs that amount of money to meet up the 1 day's balance. So the structure of Indian money market, the Indian money market basically divided into the organized part and the unorganized part of our economy. The organized sector of money market basically regulated by our central bank, that is Reserve Bank. It includes call money market, treasury bill market, commercial bills, commercial paper, certificate of deposit, repos and the reverse repos. And what are the unorganized sector? The money lenders, cheat funds, indigenous bankers, still important in rural and unbanked area. So the unorganized sector of our economy is not useless. That is useful. That is important in the rural sector of our economy. What are the RBI's rules? RBI basically regulates the liquidity through cash reserve ratio, through repo and the reverse repo. They issues the treasury bill, ensures the stability in the money market. Think one of money market as a short-term blood circulation system of our economy. Just think money market is a short-term blood circulation system of our economy, and it always ensuring the cash flow smoothly between the participants. It basically works through the acceptance house and the discount houses. Today basically we discuss the terminology. So what is acceptance house? The acceptance house means basically specialized institutions that accept the bill of exchange and guarantee the payment on behalf of the borrowers. Mostly developed in the United Kingdom. In India, the commercial banks performs the role. Basically, the acceptance house developed in UK, not in India. In India, the commercial banks performs as the acceptance houses. Suppose an exporter draws a bill of exchange and acceptance house accept it. That is the guaranteeing the payment, make it tradable in the market. So what is discount houses? The discount houses basically the institutions that specialize in discounting the bill of exchange and the treasury bills before the maturity. When we all just done our bills of accounts in our HS journey, so basically at that time we discounted the bill before the maturity. So provide basically discounted houses provide the liquidity to the bill holders for a short-term securities, and the interest rate that charged by them is the basic earnings of them. In India, the discount and the finance house of India basically was set up in 1988 for this purpose first time. So if a company holds a treasury bill maturing in 6 months but needs money now, so he can easily sell that is discounts it to the discounting house of India for immediate cash. So at first we try to just getting the concept of money market, that is a short term fund. Structure of Indian money market, there is a two type of sectors in Indian money market. It is organized sector and another one is the unorganized sector. And the next thing, the role of the acceptance houses and the discounting houses in our money market. So we learned that the money market is the place for the short term borrowing and lending. We discuss its concept, structures and key institutions like acceptance and the discount houses. And now we will focus on the call money market. We will focus the recent trends in the Indian money market, and with the try to develop some practical examples. So what is call money market? The call money market is the segment where the funds are borrowed and lent for a very short term period, for 1 day to 14 days. The commercial banks mean the borrowers and the lenders, cooperative banks, primary dealers, Reserve Bank. Reserve Bank basically plays an indirect role through the monetary policy. What are the importance of call money market? The call money market basically provides the immediate liquidity to the bank. It is very helpful. And call money market helps the maintaining daily cash reverses. Act as a just barometer of the liquidity condition in the economy. Here the call rate is important. What is call rate? The interest rate at which the funds are borrowed or lent in the call money market, that is call rate. Highly volatile. This market basically highly volatile, and this market can change the multiple times a day depending on the demand and supply. It is market derived rate, not administered rate. If I say a practical example, suppose HDFC Bank has excess cash today, but ICICI Bank is a short of funds to meet the RBI CRR requirement. CRR means cash reserve ratio. So ICICI borrows from HDFC over the night in the call money market at the prevailing call rate. If the call rate is very high, say 15%, it signals a shortage of the liquidity in the banking system. This is very important, very significant, this call rate. So that's why call money market is very, very important. So what are the recent trends in Indian money market? As a developing country, our nation develops our Indian money market also. So at first they developed of some new instruments, treasury bill, cash deposits, repos become more active, introduction of DFHI. What their role? They boosted the secondary market for call money market instruments. Integration with the global market. We all know the liberalization, privatization and globalization would take place in 1992. The liberalization basically in 1990s opened up the money market to the foreign players. Now electronic trading platform, negotiated dealing system, market reforms, linking with the call money market with the rates with repos, linking the liquidity management to the repo and the reverse repo, enhancing the transparency in call money market transaction. Suppose in COVID-19 time, in the year 2020, RBI reduced the repo rate to 4%. Injected liquidity. Call rates fell sharply, indicating the surplus liquidity. And at that time, global financial crises, when in the year it would take place in 2008, the call money rates spiked to double digit in India due to the liquidity crunch. And at that time, Reserve Bank of India intervened with the liquidity measures. So to conclude, in a nutshell idea, over the call money market, it is a hub of short-term fund in any economy. In India, it has evolved from an unorganized system of money lenders to a more modern and the regulated structure under Reserve Bank of India. It is developing, not is being developed. We explored the acceptance houses, discount houses and the call money market, and we saw how the interest rates here reflect the liquidity in the system. That is more crucial, more important. And the recent reforms and the technological advances have made the Indian money market more efficient. Through the challenges like the volatility and the dependence on RBI still remain unchanged. When we move to our next unit, we will connect the money market with the capital markets, because our next unit is capital market. All the units are interlinked. With the previous unit, interest rate is linked with money market, and we will connect the money market with the capital market to see how the short term and the long term funds are worked together in a financial system.